We just have a quick question here from a subscriber saying that they've recently noticed in one of our videos on our charts that we are not using the TIPS ETF for tracking gold and real yields anymore. We're now using an ETF called just TIP, and they're asking why we've made the switch. So thanks for the question. The answer really isn't that major. I'll explain it. You're right. We like to use TIPS ETFs as a proxy for real yields, but we have changed the ETF that we used to use due to the one that we used to have has started to decouple slightly from real yields and gold. So we've basically moved over to another one. But before I explain this in more detail, though, I think it's very important to understand that the decoupling has been mostly driven by or compared to one specific TIPS ETF. And the reason for that is the composition of the ETF. And it doesn't have anything to do with the inverse correlation between something like gold and real yields in any way. So, when you look at gold, as you know, it's got numerous different drivers that affects it, such as the US dollar, inflation expectations, risk sentiment, QE, and we also have interest rates. But out of all of these, the biggest and most important driver of gold is really real yields, or nominal bond yields minus inflation expectations. Now, if you look at any type of TIPS ETFs, they are treasury inflation protected securities, and they are something that you can trade as a security if you're trying to take advantage of inflation moving higher or lower, or you can just use it as a proxy for real yields, which is what we like to do. But it is important to understand that there is plenty of TIPS ETFs out there, and all of them will have different holdings and different weightings. So some time ago, before we knew about the great TradingView plugins from Quandl, we basically had to rely on TIPS ETFs to track real yields. And the one that we used was the one from SPDR, the Barclays US TIPS ETF. And that's the one with the ticker called TIPS. So that's the one, if I just get that on the screen, that's that blue one. So let me just take that back. So you can see that it did closely approximate the moves that we can see in gold, but it has started to decouple slightly from both gold, and if we just invert that, and real yields as well, which is obviously not something that we want to see. Now, the good news is recently we've also learned, like we said, about the Quandl inputs or codes, and that's the one in purple, which has given us a way to track real yields a lot closer. But the only letdown for me with this one is that it only updates daily. So there's no intraday view for how you can see real yields moving in real time, and that's frustrating if you're trying to trade something like gold in the short term. So what I did is I just went through a couple of different TIPS ETFs available in TradingView and tried to find one that more closely resembles real yields. And the one that I like to use right now, like you saw in the charts, is the iShares Trust ETF, the TIPS ETF, with the ticker called just TIP. So let me just get that one on the screen. So you can see that's that dark blue one. You can immediately see that it tracks gold prices a lot closer compared to the TIPS one. And if I just hide the TIPS one for a second and I invert that scale, you can see how closely it resembles something like real yields, which is exactly what we want to see, because we're using it, of course, as a proxy for real yields. Now, the reason for the differences between them, again, it's got nothing to do with the inverse correlation between real yields and gold. The difference between these two is really just in their composition. So if we just quickly go to the SPDR one, you can see this is the different holdings. Unfortunately, it doesn't have descriptions for the names, but you can see it's got a short list of holdings with different weightings, ranging from 3% all the way down to 2.8. And if you compare that to the TIP one, the one that we're using now, you can see it's got a much bigger range of treasuries that it's tracking, and obviously a very different weighting for each one of them as well. So that just explains that, it's not a change in that overall inverse correlation. It's really just the composition of the TIPS one that's basically been seeing it moving a little bit out of sync based on the way that we've recently seen treasuries and treasury yields move across the curve. So it's important to understand that it's not a decoupling of real yields for treasury inflation protection, protected securities in general. It's just a change in the holdings of that one specific ETF that has made it move a little bit out of sync. And that, of course, doesn't mean that the iShares one that we're using now is perfect. if we just look at the chart, you can see there are still differences. Even if we move up to the most recent price action, there are differences between that and real yield using the Quandl version, but it's close enough for our liking. And better yet, it updates during exchange traded hours and not just daily like the Quandl version does, which is great. So I hope that explains the move from tips to tip a little bit better. And as always, if there's any other questions, don't hesitate to let us know.